Hello, welcome to the Asset Allocator podcast. I'm Aamina Zafar, funds reporter at AA. Joining me today is Ed Cole, head of multi-strategy equities at Man Group. Hello, Ed. Thank you for coming on.
Thanks very much for having me.
Also in the studio, as always, is our very own contributing editor, David Thorpe.
Hi, Aamina. Hi, Ed.
In this week's episode, we'll explore how investors can build resilience in today's ever-changing market. With fresh opportunities in equities, fixed income and alternative assets, where should investors be focused? So Ed, as you know, diversification is a buzzword on everyone's lips right now. How are you approaching that in terms of equity allocation?
I'm actually delighted to hear you say it's a buzzword because we think it's the sort of thing that is probably critically important to how everyone should think about our portfolio. But in many ways, the last 15 years, let's say post-global financial crisis, great financial crisis, has been one in which it's paid not to diversify.
Really?
It's been a world where, in fact, if you had perfect foresight, you would have had as much exposure as you possibly could to a small subsection of US equities and probably ignore the rest of the world. So it's been a world where diversification hasn't paid as well as it normally would, but nonetheless, we think it's critically important. I think the thing that we think is of utmost importance in the world today is that the basic building blocks of the multi-asset portfolio, which is how all of us have been saving, really, anyone I think probably born from the 1970s onwards, has experienced a world in which traditional assets have been very diversifying towards each other. In other words, when equities have had a difficult time, bonds have tended to do very well. Mm-hmm. And that's been the basis of the 60-40 portfolio, and it's worked extraordinarily well. And our concern is that we find ourselves today in a changing global economic and political regime, which is starting to create dynamics that are changing the interaction between traditional assets. And as such, the 60-40 portfolio is no longer as resilient as it once was.
In that environment and paying attention to your job title, how do you think about diversification within equities? If bonds can't do the job maybe that they did in the past, or that theory suggests they should, is there a case for diversifying within equities, and what does that look like? Because I mean, you can cut the cake three ways. You can say, well, having lots in the US paid off, but having lots in US tech paid off. But even now, if you say, well, what's the opposite of US? The opposite of US is sort of emerging markets. Well, emerging markets is now a tech-dominated market as well. So what does diversification look like within the equity pie, and how do you think about that? Is it geographical? Is it sectoral? Is it something else?
Yeah, so I think it's, look, I think the theory, the academic theory about alpha in equities, excess returns in equities, or excess returns in any asset class, is that you want to diversify your number of independent bets. Right, that's what the academic literature says, and it's something that I think has been somewhat obscured by this concentration phenomenon in markets, which you're describing well there, David. Our response, without it being a specific recommendation to buy X and sell Y, at a point in time when US equity markets on multiple different indicators are expensive, so I'd say the one indicator today that doesn't look expensive is the forward PE multiple. So price to earnings, looking at earnings expectations. Are those earnings expectations incorporate?
Do you mean that for the whole? That's CAPE, right? Do you mean that for the whole market, the whole world? I mean, or just for some markets?
So thinking about where the concentration is greatest, that's US equities,
Sure.
Right? And actually not thinking about the CAPE, which uses trailing earnings.
Okay, yeah.
And CAPE is extraordinarily expensive. So we have an indicator that one of my colleagues, Henry Neville, and I would really urge everyone to read his work, which is on Man Institute website. He writes really digestible, brilliant insights into macro and asset classes. But he's done an exercise looking at multiple different valuation metrics. And on those, US equities are in essence in their upper 90th percentiles over almost 225 years of data. So this is a generationally expensive equity market. The one metric it doesn't look expensive on is forward earnings. So that's where you take into account the expectations that analysts have of growth today. And the reason that doesn't look expensive is because there is a euphoria about the prospects that tech AI can bring to markets, and there's a circularity in all of that. Leaving that aside for the moment, because it's a different thing, US equities as a starting point, we think, are exceptionally expensive. And when you have an asset class, single asset class that's exceptionally expensive, what history tells you is that forward returns from that point are typically underwhelming, right? So we've been through an environment where US equities have beaten everything handily. The last 3 years, they've annualized at 20%, which is extraordinary. We would say it's a reasonable time. And in fact, it has been a reasonable time for a year at least to be thinking about other ways to express your long exposure as a saver in equities. What might be interesting? I mean, we think diversifying geographically is interesting, right? There are other parts of the world where there are other interesting equity stories other than narrowly tech and AI in the US. You can look at, as you've already said, there are tech and AI winners outside the US. That's not necessarily diversification, but there are tech winners in China that are, I would say, ignored at the moment today. There are whole large areas of equities which are interesting. There's a large fixed capital investment story in Europe, which was quite interesting to people a year ago, and today with all the normal friction of political change in Europe, that spending on energy, revitalization, on defense, those things have kind of waned a little bit, but they are mega trends and they are here to stay. I think that there is clearly opportunity outside the largest cap companies everywhere in the world. We've been in a world where through the last 15 years, it's been winner takes all. The biggest tech companies have taught investors that actually, if you can build a moat around your business, you can build a platform that's winner takes all. And that has overturned the theory in capital markets that actually larger cap companies underperform over time. So we've got all of these things that in the last 15 to 20 years have been dependable observations that people have made. And we think that the regime's changing. Your question is where? I think that the answer would be everywhere, because that's what diversification is. It's about understanding that opportunity is broad and not crowding into one thing.
What's one diversifying from in that scenario? Is it diversifying from expensive equities, or is it diversifying from tech, or is it diversifying from expensive valuation, or diversifying from theme, or diversifying from country?
I think it's all of those things. I think that's the nature of diversification. I think that a critical one is to think about size. There are extremely interesting smaller cap opportunities out there. So size would be one. Valuation would be another. Sector would be another. Geography would be another. There is an enormous breadth of opportunity in global equity markets. And today, really for the last, it's hard to cut exactly where the point was in time, but we've been talking about US exceptionalism for about 5 years. A really interesting thing that, I was having a conversation with someone about US exceptionalism a year ago, and my response to the idea of anything being called exceptional is a warning bell that you want to run from, in the sense that, there is nothing exceptional. There are moments of euphoria. There are moments of hype cycles that draw people in. The narratives become so compelling. But actually, is there anything exceptional about any opportunity? No, ultimately it comes down to whether or not the valuation is correct, the growth opportunity is correct. And actually, since that term sort of really started to emerge about 18 to 20 months ago, US equities have not done any better than anything else. We sit here today and look at a narrative which is all about Anthropic and OpenAI and actually, even sticking inside the US, the Russell 2000, which is a sort of out of fashion index which incorporates smaller cap stocks and has more cyclical characteristics and more value characteristics than the S&P 500 or the Nasdaq, has outperformed. It's outperformed, I think, because there are underappreciated opportunities. So that's what diversification means to us.
Coming up later on Asset Allocator, we'll explore the role of alternative assets and where to add value in fixed income. Join us after this quick break.
Opportunity is everywhere. Access is everything. Access is expertise, guiding you with local insight. Access is discipline within a diversified approach, from traditional asset classes to ETFs and alternatives. Access is connection across a global footprint. Because when the world of opportunity is truly in reach, access is everything.
Welcome back to Asset Allocator. So Ed, in terms of inflation outlook, how do you see that shaping portfolios over the next year or so?
Yeah. So I have to be humble about what I know and what I don't know. I think what I don't know is how to forecast things. We're not really in the business of forecasting things. We're in the business of building robust portfolios. Having said that, I think there are probably two major forces going on in inflation dynamics today. I think on the one hand, we have what we believe is probably a secular trend towards more sticky inflation. Mm-hmm. So, since COVID, there's been more friction in the global economy. Supply chains have been getting stickier. There have been continual shocks on the supply side. Energy seems to be a recurring shock. There have been, just sort of supply chain disruptions through COVID, through Iran. And all of these things are putting inflation into the system. I mean, the most recent one seems to be in the US, it will become a global phenomenon, is CPI in computer hardware. Mm-hmm. So there's generally an inflation bubbling in the system. And I think you can see that most clearly in the fact that inflation expectations in markets sit quite comfortably above the 2% that the Fed targets. You can also see that measures of sticky inflation or acyclical inflation that are published by central banks are showing a greater tendency towards the parts of the CPI basket that are not economically sensitive are increasing over time. So, I think what emerging market policymakers understood a long time ago is that once inflation is out of the bottle, it's hard to put it back in again. Mm-hmm. So generally, I think inflation is probably stickier, higher for longer. And I think the probability is that the 2% targets that we became used to are likely something that will fade into the rearview mirror. So we all have to get used to higher inflation. Mm-hmm. And I'll talk about why that matters in a moment. Having said all of that, I actually think right now there are probably growing signs that locally inflation has peaked. The big driver in the last 6 months, of course, has been energy prices, which increased 50% in oil and more in natural gas in some places because of geopolitics, and that seems to be fading now. So, all things equal, I think probably locally inflation has probably peaked. But what we have to keep in mind is that there's a secular trend towards it being stickier. Why that matters is that when inflation moves higher, and what higher means to us from the work that my colleagues have done is when core inflation in the US moves above 2.5% on a long run basis, it tends to result in the relationship between bonds and stocks changing. Mm-hmm. So over all of our investing lifetimes, stocks and bonds have been negatively correlated. That means when stocks have gone down, bonds have gone up. And you have to think about the great financial crisis as an example of that, where the bond portfolio made a lot of money and the equity portfolio lost a lot of money. What we saw from 2022 onwards, when inflation became a problem again, is that the sign has reversed. Stocks and bonds in stress in equities when inflation is higher have a tendency to be positively correlated. That matters enormously because it means that when you're losing money on your equity portfolio, mm-hmm. the bond portfolio isn't bailing you out. So that natural diversification that we've all become used to seems to be at risk in some way. And that's the thing that I think preoccupies us and makes us think that one really needs to ask the question about how you achieve diversification today.
So Ed, what does a defensive or lower volatility equity allocation look like these days?
A defensive equity allocation for us implies taking the directionality out of it. I think the problem we experience today is that, as I said before, equities are generally very expensive. There are ways to diversify regionally and sectorally and in style terms from that. But it does make an enormous amount of sense to us today to be taking the direction out of equities. So what that means to us is thinking about liquid alts, liquid alternatives, things that are deliberately diversifying from equity beta at a point in time when we would argue that there is a fragility potentially to outright returns in equities.
At Man Group, I suppose you don't necessarily have to think about it like this, but our listeners, most of the portfolios they put together are risk targeted. So obviously they've got some clients that have a cautious outlook, and they build a cautious portfolio around it. If those liquid alts are in there, are they actually in there instead of some equities or instead of some bonds, or where do they fit in? So that's referencing back the 60-40 point you made earlier, right?
Yeah, that's an excellent question. I mean, I think how you size these things is important. And I think the way we've thought about this is it makes sense to be thinking about shrinking the whole of the existing 60-40 and applying a component of alts on top of it. So, but shrinking both sides makes sense because the attributes you expect from the 60-40 are less valuable today than they once were.
So, Ed, where do you see value in fixed income right now?
Yeah, so look, I'm going to put my hand up and say I'm not a fixed income specialist, but I am in the business of trying to build robust portfolios. There is a real utility to fixed income, right? We have to be clear about that, which is they pay dependable cash flows. They're incredibly liquid. They're the highest quality collateral you can get today. So all of those things make them a valuable part of a portfolio. That's clearly the case in government bonds, which are the most liquid and the highest quality collateral you can have. And it's then down to your bond manager to recommend which particular government offers you the best opportunity. I think the thing we worry about, which is, helps us think about where value might be or where opportunity might be. Mm-hmm. From my perspective, what we worry about is duration in inflationary environments. If we find ourselves in a situation where there is another inflationary burst, and you saw exactly this in March this year, where bonds and equities both lost money together, as did gold, is that duration is the fragility in all of that. I think that, I work with an extraordinarily talented set of credit managers, and they are acutely aware that spreads are extremely tight everywhere. But they also understand that credit selection has an enormous alpha still attached to it. So I think we can break that down to say there is utility in owning bonds, government bonds, because of their quality, their collateral, their cash flows. There are selective opportunities in credit because the dispersion inside credit indices is significant. But if you worry about inflation, and as I say, for us, stickiness in inflation is a concern, then you have to worry about duration.
And at the moment, do you believe the market pricing reflects those worries? So you mentioned earlier the market has its inflation expectations considerably above the 2%. Is that also reflected in how duration is priced?
Yeah, I mean, look, again, I'm not a bond specialist, right? But I would take a step back from that and give an answer that I've learned over 25 years in markets. The market is always right. Okay, it is always right. We sit here. You could look at other asset classes. You can take energy this year, where there was a loud chorus of people screaming about how energy prices had to be higher. And actually, what we can see today is that if you take geopolitical risk out of it, there's a glut of energy in the world. I tend to take the view that we can all have views in markets. We have to. But if you die on a hill on those views, you're doing a very bad job as a portfolio manager. So for me, the market consistently pricing, let's take, for example, the UK, consistently pricing UK with higher yields, essentially a higher government spread versus other countries. That's been consistent in place over time. I wouldn't pick a fight with that. I think the market's right.
So, Ed, just to wrap things up really, touching on alternative assets, yes. Do you think there's a role for alternative assets to remedy some of the issues in traditional portfolio construction?
Yeah, absolutely we do. I mean, we're an alternative asset manager, so guess what? We think that's part of the answer. I think you have to be very careful about what alternative assets are, right? I think if you look at what exists inside most people's universe of alternative assets, it includes privates, which have a role, but which may well not be so diversifying in the next cycle as they've been over the last 20 years. It also includes, often, particularly in the UK, it includes unit trusts, investment trusts. Those are often long duration assets wrapped up into equity-like vehicles. And they may, as we know in 2022, had a duration exposure in them. So let's be clear about what alternative means. Alternative to us means something that delivers you a dependable, diversifying return versus traditional risk premia, bonds and equities. That's what we do. Mm-hmm. We believe they have to be liquid, because you have to be able to liquidate them when you have funding needs in the rest of your portfolio. So if you can do that, if you can find things that deliver you a low beta to equities, a low beta to bonds, and can pay you a reasonable expected return, irrespective of how traditional assets perform, and can do that with high liquidity, I think they've got an incredibly important role to play in the portfolio.
I mean, I guess the challenge, and you alluded to it in your answer, is lots of things that in 2022 were called alternative, they were still priced off bond yields. Yes. So if the reason to own the alternative then was instead of bonds because you thought bonds were expensive, that didn't work. And many people take the very hair-short view of alternatives, that there's no such thing as an alternative. Everything is either buying a future cash flow, which is an equity, or a piece of debt, which is a bond. And everything is priced off one or other of those. So when you're thinking about an alternatives allocation, what is its job? Is it to be a diversifier from the other two things, or is it something else?
Yeah, I mean, I think it has three roles for us. So the first is to be diversifying, to behave differently, and there are different ways to achieve that. The second is to be liquidatable when you require it. So it is no good, I don't believe, in a world of potentially elevated volatility today to have a diversifying return stream that you can't access when you need it. And the third is to, in a world of potentially increasingly uncertain returns from traditional risk premia, bonds and equities, is to pay you the kind of return you need to meet your liabilities. So we believe, in my day job, which is equity market neutral, we need to be able to earn high single digit returns net of fees, and to do that with a very low beta to equities, and to do that inside structures that are daily dealing or monthly dealing, so that our clients can tap them for capital when they need them.
Well, thank you so much for your time, but that's all we have time for today. Thank you, Ed and David, for coming in.
Thanks so much.
And thank you to our audience for tuning in. Be sure to come back next week for the Asset Allocator podcast, which you can watch and listen to across all podcast platforms. You can also log onto our website, ftadvisor.com/asset-allocator for more information. Until the next time, goodbye.